All right. So, welcome to this seminar on how to increase the value of your commercial real estate. My name is Richard. I will be your host today, and this is presented by SoCal Warehouse. And yeah, we look forward to connecting after this presentation. Wherever you're watching this, don't hesitate to reach out to us. But today, the goal is pretty simple, and that's to educate you all, if you're watching this video, how to increase the value of your commercial real estate. Something I'm very passionate about. As mentioned, my name is Richard Rodriguez. I am a commercial real estate broker, also a commercial real estate investor. So I'm wearing two hats in this presentation today, and my goal is to help you guys all understand how your property is valued and also how you can increase the value through these simple tactics and tools that are really not talked about that I personally have utilized in my own portfolio to increase the value of my property. So, moving right along. So, why is it important, first and foremost, to increase the value of your property? Why does this even matter? First and foremost, your net worth. I don't know about you, but I want to increase the value of my net worth because I know that my net worth has a direct correlation to my financial freedom. The goal of this game, if you want to call it, this real estate investment game, is really freedom. And early on in your investing career, you may be still stuck in the rat race where you're still needing to work, trade your time for money. But eventually, as you scale your portfolio, your net worth increases. But more importantly, you start to pick and choose what you want to spend your time on because your properties are dumping cash flow and they're appreciating, and just a number of benefits that real estate has that we'll go over in this video today. But really, that's number one. You want to increase the value of your property because it has a direct correlation to your net worth. And if you don't know, your net worth is your total assets and deduct your total liabilities. And that number at the end that's left over is your net worth. Okay, very important number to track. I personally track this very often, and once a quarter at least, based on new investments or new liabilities that have come into my life. Okay, so you increase your net worth. And then number two, access to capital. Real estate is a very interesting asset where you can leverage and you can, really take the benefits of real estate, which is debt, on the property tax free via refinances. Okay, so in this video, we're gonna show you how to increase the value of your property, but also how to access and how to position yourself to access the capital that is inside that you create, the value that you create on your properties, whether it be, like I said, a refinance or an exit overall, where you're going to liquidate the property in an exit, either completely cash out or do a 1031 exchange so that you can continue to scale your portfolio. Okay, so these are just two of the main reasons why it's important to understand and really seek to increase the value of your property. Okay, so question for you all: how do you value commercial real estate to begin with? That's a big question. Some of you may know, some of you may not know. So there's really two simple ways on how you value commercial real estate, and here they are. So one approach is the comparable approach. That's here to your left, the purple side are comps, right? You're comping your property, your specific property, to other properties that have recently sold that are the same asset type, right? Whether it be, in this case, a warehouse, industrial, or another retail property that is comparable in its build, right? In what it has to offer as far as the structural components of the property when it was built, the height clearances, certain power supplies. Does it have comparable land as well? So these are all obviously comparable market as well, right? Everything is very market driven. So is it within a vicinity? Is it off a main road or an industrial area that's very in demand? Is it zoning? So all of these things have to come into play for it to be a comparable property. And this is why it's always good to have a network of brokers that can assist you in understanding how your property comps out to other properties. Okay, but the reason why I personally don't like valuing commercial real estate based on comps is because you cannot control certain things, right? The comps are given based on what your neighbor sold as a comparable property. So price per square foot is really all you can base it off of, and it's cyclical, right? You could have a you could be in a down market where comps are going down, sales values are going down, and you have, you know, a 10% decrease in your value than it was 12 months ago, because it's cyclical. Real estate is just a cyclical industry. And and what I mean by cyclical is values go up and down, up and down, up and down, right? It really always, right? Nothing goes up forever, nothing goes down forever. So if you base it off a comparable approach, you are really handing over the value of your property to the market, right? So the second approach, which is the approach that I recommend, we all understand and we all strive to achieve to value our properties based off, is the income approach, and that you can't control. And that is based on a simple formula that all commercial real estate is valued off of. Lenders value your property like this. Investors value properties like this that are seeking to invest and park money into an asset that's going to yield a return. So this is really where we're going to focus on today, the income approach. Okay, this is the goal for everyone to understand how to value their property based on the income approach. Why? Because it's the way you can control the value of your property. All right, so let's get into it. So the value of your property, the equation is NOI divided by the market cap rate. Okay, so let's break this down a little bit. So value of commercial real estate equals NOI, which is an abbreviation for your net operating income. Net operating income. Okay, divided by the market cap rate. So we'll go over these into detail now. So the NOI is an abbreviation for net operating income, which all it is your gross revenue deducted by your operating expenses. Okay, so your gross revenue is your total rents that you're collecting on that property yearly. Okay, we want the yearly amounts for both of these as well. So your gross revenue is your yearly rent amount. Okay, so in the example that I give here, it's $72,000. So if you divide 72,000 divided by 12, that would give us the monthly rent, which in this case is $6,000. Okay, $6,000. But we want, in order to determine the net operating income, we want to get the yearly amount. So 6,000 is a month is 12,000 total revenue. Okay, but in order to get the net operating income, we need to deduct the operating expenses. What are operating expenses? These are taxes, insurance, maintenance, utilities, many more that you may have on your property. This could be laundry, landscape, you name it. Depending on the type of property you have, it may have more operating expenses than other type of properties. For example, we're going over warehouse properties. They generally have lower operating expenses than a multifamily property would have. You know, in most cases, it's pretty standard that even on a gross lease, the tenant will pay for the utilities. For example, on a warehouse. So, okay, now that we understand net operating income and how to calculate it. Okay, and this is the formula right here. You might want to screenshot this one, keep this one in your back pocket because it's a very, very important formula. The value NOI divided by market cap rate. Okay, so we understand net operating income is just your total money that you're collecting in rents deducted by your total operating expenses yearly, and that's your NOI. The cap rate, okay, another component of the equation is given. And this is another reason to have a good firm, a good brokerage on hand, a relationship with them, that they can educate you on your local market, because the cap rates change within different markets, within different asset types. The cap rates for multifamily are different than from the cap rates in residential, multifamily. They're different than the cap rates in retail and office. These all change within a given market in the same exact location. So you can imagine how they also change within locations. So it's important to have a relationship with these brokers like ourselves that know the market to educate you when you are trying to get a value for your property. They get, it's one phone call away, and you can get this cap rate, which you're going to need in order to determine the value of your property. So this is given. This is also a market-driven component that the market determines, and it does vary between asset type, property type, and market. Okay. So I have an example here for us all. So $72,000 is the gross revenue. Okay, and we deemed that $6,000 a month on, and this is a real example. This is actually a property that I own. So $72,000, I have a property rented out on a gross lease for $6,000 a month, which is $72,000 yearly, gross. And my total operating expenses is $24,000. This includes my property taxes and insurance. Okay, those are the only two operating expenses I have on that property that I personally cover out of pocket. Therefore, my NOI, right, what's left over net in my pocket yearly is $48,000. Okay, and this is pre-tax. This is pre-tax dollar. Okay, so this is $48,000, and that's fine. That's how a bank would look at your NOI. That's how they would value your property, is based on pre-tax. $48,000 is my NOI. So now I have $48,000 as we determined here up here. Value equals NOI divided by your market cap rate. $48,000. The property that I'm referencing is an industrial property in LA County, which yields a 6% cap rate right now. It's trading at a 6% cap rate, and that's given. And I know this because I work in the market. And so I just divide the 48,000 divided by 0.06, which is 6%, which gives me a value of $800,000. Okay, I could literally take this to the bank. Okay, I could take this to the bank, and they will value this for the exact same amount. Okay, they will run the exact same formula like this, and determine that the value is worth $800,000 because that's my true gross income, that's my true operating expenses, that's my true NOI, and this is the true market cap rate. Okay, $800,000. So the question I have for you then is, how can you take control of the value of your property? What can you do to increase the value of your property? Well, luckily for you, I have it in red at the bottom of the screen. Increase the NOI, guys. As soon as you increase this number, this $48,000, your value starts to go up. So if I had an NOI on this property, if I was able to just deduct $4,000 or add $4,000 to my NOI. So instead of $48,000, if I added an additional $4,000 to that, my NOI would be $52,000, and I divided it by the exact same cap rate, the 6%. So divided by 0.06, the value would now be $866,000 just by increasing the net operating income $4,000. I increased the value $66,000. As you may start to understand, that is a very, very important number to focus on in your portfolio, whether you own one property, whether you own 100 properties. If you could increase your NOI on any of your properties, you're going to automatically increase the value of your property. And as I mentioned at the beginning, your net worth increases and your access to capital also increases. Okay? Very, very huge. So I really want to, I'll even pull out the calculator here just so that you guys see it again. So if we increase this $48,000 is my existing NOI. Only $4,000 by increasing it $4,000, $52,000 NOI now. And if I divided that by the same exact market cap rate, which is 6%, I would get an $866,000 valuation. $66,000 more than the $800,000 valuation that I had just showed you guys all. So this is powerful. This is very powerful. So the question is, how do I increase the NOI? I understand I need to increase the NOI, but how do I do it? Well, you first start by hiring this good-looking group, that can, really go into your portfolio and start to see some deficiencies that maybe you're not aware of. But on a serious note, I'm going to give you guys a blueprint, something that we would do personally for you, but that you can do for yourself, right? Before you even give us a call, before you even reach out to any other shop that could potentially assist in your real estate goals, okay? So first and foremost is the base rent. The base rent, you want to make sure that you're at market rents, okay? We deal with a lot of industrial clients. A lot of their rents are low. They don't increase the rents. They're on month-to-month leases, you name it. So making sure that you're getting the market rent is very important. And if you have an existing tenant in place, making sure that you keep them there, because the last thing you want in the cyclical industry that we're in is you may have a tenant that is paying above market now. Maybe they were paying market when you signed the lease and the lease rates went down, which is actually exactly where we're in right now as of August 11, 2025. Lease rates have gone down quite a bit in LA County, Orange County. And what we're seeing now is that tenants that are currently have leases, they're paying more than what they would be paying now if they went to go shop for another property. So another goal is to keep your existing tenant there and keep them happy. right? And making sure that you're in communication with them, or your management is in communication with them, or your broker's in communication with them to understand how their business is doing and to understand what their goals are when the lease comes due, when the lease comes up. Okay, so first and foremost, make sure you understand where you're at as far as your rents and the market rents, and put together a strategy and a plan to make sure that that base rent is as high as possible. Okay, that's one way, because that is literally your gross revenue, right? That is your total gross revenue, the base rent. Another way you can increase the net operating income is lower the operating expenses. I mentioned that the gross income, your NOI is gross revenue minus your operating expenses, and all these taxes, insurance, maintenance, utilities. If you can find a way to deduct these, you're automatically going to have a higher NOI at the end of this. If I could get this, I don't even need to add $4,000. I could just deduct 4,000 from the 24,000 in operating expenses down to 20,000, and that would give me the $52,000 NOI, which would increase the value $66,000, right? Without adding any more income. I'm just lowering the operating expenses. And some ways that I've done this personally in my portfolio is make sure that you have the best policy. Make sure that you're getting the best deal on your insurance policy, right? Because that's something that I pay on this specific example. I pay the insurance, and I shop that. I shop that often, right? Making sure that I'm getting the best rate for my policy on my insurance. Another thing is to pass the utilities down to the tenant. Making sure that if you are paying any utilities, that when you go to negotiate on a new lease or a new tenant, that the tenants are paying their utilities, water, power, gas, and trash, anything else that they may need, that to occupy that property. And something that I don't hear often is the taxes. A lot of people think that their taxes are fixed. If you feel that your property is being valued at a higher value than it actually is worth based on the assessor's tax bill that you're getting twice a year, well, you should look into that. And I have actually done that especially if you just purchase a property and you believe that, and especially if you purchase a property and they're valuing it higher than what you purchased it at. That's something that's happened to me, and have three properties that are currently in the tax appeals board. I have cases with them all to essentially argue that they're not giving the right value, that they're valuing it higher than it's actually worth. And I am confident that I'm going to win all three of those because I have sufficient data. And that's another reason why you want to make sure you have a team with you that could help you lower these expenses, lower these liabilities, really, right? These operating expenses, because they have a direct correlation to increase your NOI. Rent increases, like I mentioned, I have a lot of clients that don't have even leases in place. Better yet, have increases in place where yearly the rent's going up. Guys, there's something called inflation, and that is your biggest enemy. That is why when you look back in 1953, you saw a house sell for $17,000, and in that same neighborhood, that house is now trading for $1,200,000. Okay, it's called inflation. The dollar is getting devalued, and inflation is a real thing. And if you could keep up with inflation, well, you're that's really one of the benefits of real estate. It's a hedge against inflation. So 3 to 5% increases is pretty standard in our market, and that's something that you want to make sure that you are implementing in your portfolio so that your value goes up as well. Because if your rent's going up yearly, well, we mentioned that your NOI is directly correlated to the amount of rent you're receiving. Okay. Tenant improvements, making sure that you budget for TIs. If you have a vacancy, making sure that you don't want any hidden expenses, unknown expenses that come about. This could be a mezzanine. This could be a sewer line. This could be an electrical panel. This could be, just cosmetically paint. You name it. Making sure that you have a sufficient tenant improvement budget so that when you go to lease it, the tenant values it more than it would versus a property that's just really not up to shape. Okay, so making sure you have that budgeted. Tenant credit, right? Making sure that when really what I'm mentioning here as far as tenant credit is we do not want any vacancies. We don't want a tenant to default on their rent, because if you're not making any money on your property, then your property is really going down in value. Okay, so get personal guarantees to secure deposits based on the credit of the business and personal. Okay, so this is something that we really do diligently, and this is something that if you have any questions on, you could reach out to us directly. Renewals in term. Okay, making sure that you have an making sure that you track when your properties are going to come up on for lease renewals, making sure that you know when your leases are coming up so that you can start negotiating renewals early. I recommend negotiating. I recommend 6 months before the lease ends. So if your lease ends in December, start negotiating in June, July. on renewal or if they're going to leave, so that you can start marketing the property so that you don't have a vacancy for long. Okay, that's what we want to prevent, because no income, really no value. Okay, so those are just six, right? Of many other ways. There's many other ways we could increase the NOI, but these are my six that I personally look at on a consistent basis in my own personal portfolio and for our clients as well. Okay, so key elements to consider. First and foremost, what are your goals? What are your goals? This is the big question. What are your goals? Do you plan to keep this property forever? You pass it down to the family? Do you want to use the property you own as a stepping stone to a larger property so that you could appreciate at a higher value? Do you plan to stabilize the property by leasing it out and then pulling money out? So you want to increase the value as much as possible so that you can have a tax-free capital event called a refinance. What are your goals? What are your goals? And sometimes it's helpful to have someone to talk to determine what options, what goals you can have as it pertains to the property. So that's another way where we're able to come in and just kind of counsel and advise, right, on your portfolio. But understand your goals is number one, and also understanding as it pertains to your goals, what market cycle are you in? I mentioned that real estate is a cyclical market. It goes up and down. Right now, we're in a down market, okay? We're trending down, which like I said, as of August 11th, 2025, I'm starting to see a swing. I think we've bottomed out pretty much across all asset types, including industrial, and we're going to start to work our way in the other direction now. So being realistic and having a plan, right? So current lease rates, understanding what the market is doing as it pertains to lease rates, forecasting, right? Understanding and being in the know of where forecasts look to be, where rents are going, and understand the demand, right? What does the demand look like for this specific asset type, this specific product, right? Or warehouse, let's call it. And within the warehouse, what type of warehouse, right? Is it a newer warehouse? Is it a 80s build, 70s build? Is it a metal building, concrete building, block building? All of these have different demands. So understanding and knowing your market is very important, and understanding what market cycle you're in, right? Very important. Your desired holding period. And yes, we have a typo here. Yes, we have a typo here. Uh, but we're human. So check it out. Desired holding period. How long do you plan to hold this property? 5, 10, 15, 20 years is very important, because if you have a short holding period, well, you probably don't want to exercise a long lease. You probably don't want a 10-year lease, a 5-year lease, if your holding period is only 3 years, because then you're going to be stuck with the tenant there when you want to exit, and your exit is probably going to be worth more, depending on the product type, to an owner user, someone that's actually going to buy it, use it for themselves. So they wouldn't have no value with that property if there's another tenant in place and they have to wait 2 years for them to vacate. So it's very important to understand, because if you have a short holding period, well, you want to make sure that you're not on a long-term lease. Okay, lender appetite. So if you plan to refinance the property, you want to understand what they're looking at. You want to understand what type of loan of value they're going to give you on that specific product. You want to understand what type of requirements as it pertains to your financials they're going to be looking at, as well as the the leverage on the property, right? How much LTV are they going to give you? 50% loan to value? Are they going to give you 35% loan to value? Are they going to give you 70% loan to value? So understanding and having these relationships, and we can connect you with some great lenders based on your goals. If you have any questions, risk and reward. Really, how much risk do you want, right? Do you want less money and higher risk with a tenant, or do you want more money and higher risk with a tenant, vice versa? It goes on, right? So there's always risk in any investment. So trying to mitigate that risk is really my goal in my portfolio, and that should be the goal for all of our clients. And that's where we step in and advise on the pros and the cons for each different route that you could take. Okay, and you rinse and repeat. You rinse and repeat. Once you understand this, you can do this for other properties. You can do this for other asset types, not just industrial. You can do this for your multifamily projects, et cetera, et cetera. It's very important to understand how to increase the value of property, because, like I mentioned, it increases your net worth. Therefore, it automatically correlates to increasing your ability to access capital so that you can refinance, sell, and go and do it again. Rinse and repeat. Or if you want to buy the new Porsche, by all means. Or if you want to get the new Rolex, by all means. We gotta enjoy life a little bit, right? But in all seriousness, this is how you increase the value of your property. If you have any questions, all you have to do is scan this QR code. You can book a call with me directly, or any of our brokers in house here at SoCal Warehouse. This is what we do. We pride ourselves in providing excellent service and really just giving you the knowledge that we personally implement in our own portfolios as well, as I mentioned, so that we could all go further together. Uh, if you have any questions in LA, Orange County, or even in other states, we also have networks. Do not hesitate to reach out. I hope you found some value in this. Like I said, if you have any questions, don't hesitate to reach out, and we look forward to connecting.